Hello, today I'm going to show you exactly how to use our free rental property calculator spreadsheet and in Excel. This financial model is sophisticated enough to do scenario analysis for both single family residential rental properties as well as multifamily, including duplex and triplex rental properties. This is not your ordinary calculator. This is the same model that I've used to price out millions of dollars in real estate transactions and has helped me close on over $1.2 million worth of rental property within my local area. I'll show you exactly how to run various sensitivities as well as how to price out an exact real estate property. So the first spreadsheet that you'll see once you have the model is the inputs tab, and this tab is really your dashboard for inputting any key input that would go into the model, and it's fully customizable, so you can add, delete, remove, change any sort of input here, and it'll flow through the model. There's various hard entered numbers that you can link back to here and create your new input that will then show your ultimate output on your financial returns, which is down here in the bottom. So I'll run through an exact case study on a local rental property in my area and how I would think about valuing that piece of real estate. Here is your normal revenue schedule. You'll put in monthly rent, number of units, increase in rents over time. Some of these you'd have to check to make sure that they're not linked back to inputs. You can see that rent escalation is tied to the inputs tab here. But that is, again, fully customizable. I like just using a flat 2% increase, so it's just, it's fully tied to the inputs here. Same thing goes with vacancy rates. You can change your inputs depending on how you like. I like holding vacancy rates the same. I'm not an economist. I can't predict that year 4 vacancy rates are going to spike to 5%. I just can't make that judgment call, and so I'm fine holding most of these flat throughout my projection period. Expenses, this is all the operating expenses that you'll build up to. None of these are on the inputs tab, so you'll want to hard enter these numbers as you go with this case study, and I'll show you exactly how. Operating is your financial dashboard and your projection period. The mortgage tab is based off of just a 30 years fixed mortgage. I have 5% in there that's fully customizable with monthly amortization. Just a real simple mortgage schedule that will ultimately amortize depending on what you input here, based on term, interest rate, and amortization. BTCF is before tax cash flow. Now this takes into consideration debt service to get to a before tax cash flow build. ATCF is after tax cash flow. That is obviously dependent on your purchase price and uses depreciation to get to an after-tax value based on any income taxes that you'd have to pay throughout your projection period. Sale is your dashboard for your ultimate exit. This is sort of a situation where you'll need to customize this to your suiting. I like to price out real estate transactions with a 5-year hold period. I know some people buy real estate as a forever asset. They never plan to sell it, but in the event that I can price a 5-year sale at time 0, might as well. I think I don't reflect any inflation in value unless I'm sensitizing it and trying to see the returns. On my base case scenarios, I usually hold the purchase price constant. That gives me a good barometer of how well this asset can perform without taking into consideration macroeconomic events. Those events I can't control. Things I can control are things that are included in the pro forma, like expenses, rent increases, in ensuring that the place is fully leased out. Ratios, I don't use these too much. You can use kind of a gross rent multipliers to try to come up with a estimated market value. This is good for bidding into properties and trying to come up with a rough range of value. Same here. This is more of financial ratios as well as profitability metrics that will help you ultimately determine how good of a piece of property that you're getting for the best bang for your buck. DCF, this is the most important tab. This is the ultimate output that'll show your financial returns on an internal rate of return basis. I have your overall multiple, which is basically the amount of cash flow that you receive, that inflows that you receive over your ultimate equity investment. And I'll walk through exactly how to digest this schedule. This is done both on a before tax cash flow basis as well as a after tax cash flow basis. And then risk, this is based on different discount rates. You can determine how appropriate your equity check and equity investment really is, as well as your payback period over the life of the investment. I don't use this a ton, but it's a good gut check for the cash flow of property. Each property is different, and so use your best judgment on how you want to use these tabs. All right, let's get into an exact case study that will help you understand the model and how it works. I can walk through exactly how I'd input each of these pieces of information that will ultimately go into the financial returns, and then you'll know how to use the model. So here in my local area, there's plenty of properties for sale. I like looking in the Twin Cities where we have a very high sort of rent density. Minneapolis is generally a good market for rental properties. There's a number of different schools in the Twin Cities area, as well as obviously lakes and a sort of vibrant downtown scene. This property here is somewhat interesting. It's a 7-bedroom, 4-bath triplex priced at $630,000. There's some metrics. The actual value is slightly lower at the Zestimate at $616. Let's see, based on the cash flow parameters, really what price makes sense for a real estate investor to actually bid for this property. You can see a rent Zestimate. I don't typically use that. I have a better resource that I'd like to recommend, and we'll get to that in a second. But this is indeed a triplex. You can see, I think there's, pretty sure, yep, owner-occupied triplex. This is a great area. It looks like a decent rental property. There's a number of different, upgrades that could be done, but it's pretty standard issue in a high rent area. So in order to evaluate the actual rent market for and comps for this exact location, I like using a tool called Rentometer. So I'll just go and copy the address in here. Rentometer.com will help give you exact comps, rental comps for the area. I believe the mid-level unit, the first unit is a 3-bedroom, and then the others are both 2 bedrooms. So that takes up the 7-bed, 4-bath. So let's do the 3-bedroom just because it's the biggest, and then we can analyze property. So average rent for a 3-bedroom in that area is about $2,000. Um, if you go to a two bed, and this will give you the exact comps. You can see you get five free reports before you have to sort of sign up for a premium version, um, which I do generally use the Rent-A-Meter Pro. I'd suggest you look into it if you are a frequent real estate investor and look at a number of different properties in your area. Um, so then the two bedrooms in this area are around $1,500. So let's say the total for these three units would get you to about, so 1,500 plus 1,500 plus, I think the three bedroom is around $2,000 on the median. So $5,000 in total gross rent. So let's go ahead and input that into our base case. This is on a per unit basis. So you, this is sort of semantics. You can put in two or three units. It's not going to really affect your annual gross rent calculation. So what I'll do is I'll just keep two units, and I'll just say that each unit is 2,500 per month. So that's input in there. Let me see, make sure that everything's running. It's just because the upside case is running. So there we go. All right, and so then rent escalation on my base case. I don't like pricing in rent escalation. I simply don't need to. I like using that as sort of an upside kicker to pricing out a property. But with expenses, I can't really control those. So I will put in a slight escalation, things like energy costs, um, uh, property taxes, things of that nature. I can't really control on my own. Um, Rent I can. Perhaps a 3% barometer is what some people use, but for me, I like not showing rent escalation because if you get a good tenant, I'm more willing to rent it out to the same person at the same price or maybe a modest increase. It's just more upside for the financial returns. So then going back to the sale price, they're asking 629,900. On my base case, like I said, I like showing a sale price that is the same as my purchase price. The selling costs, every bid that I put in, my purchase price includes seller paid closing costs. I like doing that just because it pushes out my equity check or needs up front and then just basically amortizes it through the mortgage payment. So we're pretty good on the revenue side of things, but we haven't input most of the operating expenses. So here, I like putting in a salary. You can either put in the management fee line or salary expenses. I like budgeting for $100. There's three units and $100 per month per unit. So there's three units, $100 per month times 12. It gets you to about $3,600. I live in the local area, and water and utilities are generally about $100 per month. And so if there's three units, let's do the same thing. That gets $3,600. Insurance is surely not $2,076. Let's get the exact. Home insurance is $220 based on Zillow. This is a good starting point. Let's assume that, and then the property taxes are about $83.78 per year. $83.78 per year. And then home insurance at $26.46. Maintenance and repairs, this is usually the kicker that gets you. I like doing, let's do $100 times 12 and then a buffer of an additional $500 sort of holdback That might be light depending on the property condition, but that's one of the bigger sensitivities of the model as a whole. So going through, now we have our operating forecast, we have our mortgage balance. This is automatically input at 75% loan to value, so you're basically putting up a 25% down payment. You can adjust this number by putting it in on the inputs tab. But then here your debt service is illustrated as well as your mortgage balance declines over time, and this is all annual figures. Here's your before tax and after tax cash flow. You see the before tax cash flow is sort of declining over time, largely due to the increase in the operating expenses. We might want to adjust our rental escalation assumption. And then our sale calculates our sort of before and after tax value transaction costs. These are both zero because I like to include those in the purchase price and the sale price. So a DCF, so the before tax basis is about an 8% return at this purchase price. You're putting up a down payment of $157,475, which equates to about $10,000 of annual income. Due to amortization of the loan and the mortgage, you're going to have some capital appreciation in here of about $40,000. On a monthly basis, this is only $800 of monthly income. Not a ton, but it's such a behemoth of a property that you get economies of scale once you start amortizing the mortgage. You can sort of build up a big equity balance. You're just dealing with larger dollars. So your internal rate of return is about 8%. Not great, but not horrible. I think I sort of price this pretty conservatively. So let's sensitize this a bit more. So this will show the power and the ease of use of this dashboard. All your returns and everything will just be shown here, so you don't have to tab through all the different tabs. So if we adjust that, you can see how sensitive this can get. So at a 3% escalation, now you're getting into a 10% return. Vacancy rate in Minneapolis is generally about 3%, so we can include that there. As a base case, this is starting to feel pretty good. Let's maybe put that at 2% or even 3%. So now we're matched escalation and operating expense escalation. Okay, so now we have room for what I like to call upside, downside, and recession cases. These help sensitize the sort of the bandwidth of your returns, and you'll be able to see basically the economies of scale that you can get with this property. On a downside case, I like taking the same purchase price, same exit, but let's keep, and same rent rate, but let's do 10% vacancy rate, an escalation of operating expenses about 3%, no rent escalation. Okay, so downside, you're looking at about 6%. Your pre-tax net proceeds are about $50,000. So over a 5-year hold, you make $50,000 of profit. Recession case, this is when things sort of fall through the roof. Let's say we start recontracting this at a 5% haircut off of what the existing comps are. You maintain about a 5% vacancies, and then rent sort of decreases continuously over the next 5 years. You purchase the property at the list price, and then it decreases in 10% in value. Maybe that's too harsh. Maybe 5% in value over 5 years. And then you also have to pay transaction costs out of your own pocket just to sell the property. So what does that do in terms of financial returns? An IRR, we're basically break even. You get your money back. You lose about $2,500. Not bad. It shows a little bit of the value of real estate and how stable real estate can be as an asset class. Again, this doesn't take into consideration that additional capital costs or things that you'd need to do there. Um, if the roof caved in, you'd obviously have a massive fee unless insurance covered it, which they should. Um, so still not a bad outcome. Looking at the upside case, let's think about this as on the opposite direction. We're able to re-rent out the place at a 5% improvement off the current rate. We have rent escalation of 3%. We hold vacancy at 1, so the property is 99% occupied over the life of the investment. We purchase it for the list price and then sell for, let's call it 5%. So now we're looking at a property that is a 16% return on a pre-tax basis and an after-tax IRR of 12.6%. And then a 2 times multiple, which is pretty phenomenal. I mean, so you take the whole life of the investment, proceeds, and then our equity check. So you're taking a $157,000 down payment and turning it into $303,000 and $303,695, which equates to 1.93 multiple. Not bad. I think that's a bit optimistic, but I've seen landlords pull it off where you end up recontracting higher rates, you reduce all your OpEx, manage the property effectively, and then continuously have the property rented, and there's additional capital appreciation just from real estate values increasing over time. So if you recall, we included some property management expense of $3,600 a year. I suggest as first-time landlords, you learn how to rent and operate properties on your own without a property management. It lets you work through the kinks and understand how property investing works. So you can delete that out of there to understand your financial returns on all the cases. Now we're at 17.9%. Our base case is 12.5%. Our downside case is 8.7%. And we still make money in a recession case. So that's how you work the rental property calculator spreadsheet in Excel. Feel free to leave a comment below. Any questions, anything I missed, happy to help. I'll answer your questions immediately. You can also visit financialwolves.com for other in-depth tutorials like these on real estate investing and all things making money. Thanks. Have a good day.